Welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack. And today we have a guest by the name of Mrs. Julie Roy. She is an established real estate investor. She's created, built, and sold many businesses and education centers, and just has a wealth of knowledge when it comes to building wealth, saving on taxes, and achieving your dreams. And we'll get into her story quite a bit, as well as some of the dreams that she's going after here in the near future. But Julie, if you don't mind just giving yourself a brief introduction, and we can dive right into this.
Sure. Well, first and foremost, thanks, Chris, for having me on today. I'm always super excited to hop on podcasts and learn just as much about you as y'all are going to learn about me. But in terms of an intro, I would say I'm a serial entrepreneur. First and foremost, I'm a mom of 4 kiddos, a wife of 20 years. We've been together actually 30, but married 20. So lots of consistency in this space here. So basically started alone way back in 2001. So I started a preschool via a loan that we received from a guy named Malcolm Banks for $25,000 at 19%. So probably not what I should be suggesting y'all do. And it was funny. My boyfriend at the time, husband now, came with me to get this loan. And they were like, just so you know, I hope you love this girl because, we're basically coming after you if this doesn't work. So needless to say, that put the pressure required to create, all the things we created and get that loan paid back in year 1. So that was a nice little push for us. But started a preschool in the basement of the church, grew that to a platform, started buying real estate, increased the business, was bought out by private equity in Canada in 2011, and then did a bunch of other stuff in between, ran some long-term care, always owning, sale, lease backing our real estate, things like that. Started to get the bug for like the love of triple net and making some passive income. And then actually found some deals in Omaha, Nebraska. So came over and bought those schools and started a platform here as well. Went from a small amount of schools to 10 in less than 3 years. So in 1/3 of the time. The first set took 11 years. When you know better, you do better. So the second set took 3 years. So it really scaled quickly, efficiently, and then was bought out again in the top of 2021 at like the height of our career, basically super full, with a wait list and just creating our final and 10th location. So it seems to be that's kind of the number. And so we coupled the sale of the preschools went to a private equity company called Apex, and we coupled that sale to a real estate group. All of our real estate we sold to a REIT called Store, and they own a lot of things in the US, and they bought the property with 15-year triple net leases in place. So it was really a beautiful combination exit for a really nice multiple. So that's our really very quick story of a long, a lot of years. My husband was also a doctor, child psych. So he had a large practice in Canada. In the beginning, I just commuted until we got settled over here. And then we moved our 4 kids and him. He shut down his practice in Canada. And then we all moved over here in 2019. So,
okay. Wow.
Yeah, it's a lot of info.
Yeah, I know. But I didn't realize the move from Canada was so recent. That's pretty incredible.
Yeah. When we actually moved over here, because you're a numbers guy, you'll appreciate this part of the story. When we moved over, I'm Canadian, right? I came as an EB2 investor, so 0 credit in the US. So the first 2 years we ran our business off of no credit. So I know that if you know about businesses or credit in general, running a business on 0 credit is really challenging. Never mind growing, organically growing this business. And so I remember going to Banana Republic here and trying to buy some suits to, throw in the closet in my apartment I bought in Omaha. And I got denied. Got denied because I had, 0 history of credit in the United States. And I just became a citizen 2 months ago. So.
Wow.
Yeah.
Funny. I was just talking to a couple, and the husband of the couple was Canadian and had gotten citizenship, and it was not an easy task. And it sounds like yours was and I don't even think he has full citizenship just yet, but it's.
Yeah. It took me 3 years of residency to apply for citizenship. And I actually, when I came over, they told me not to come over so my husband's American, he's Hawaiian, but he's both, he's dual. So are my kids, but they told us not to come on a spousal request. To come as an investor first because we were buying the schools. And they said that would be, a better way, to start the investment. But the issue was no credit, no history in the US, right? So just an added amount of challenges in the business world when you're coming in on 0 credit. So,
right. Yeah. How did you mitigate some of those challenges? What were some of the approaches that you took? Especially in the real estate space. I don't know how it impacted your investing, but.
Well, so it did actually. Initially, we bought the schools. We bought the schools there were a group of schools. They were underperforming. The owner was in her 80s. So looking for a legacy exit. Can you imagine? I know. I'm like, Jesus. So she was awesome though and super committed to Montessori and wanted someone who really had that passion. So we actually ended up having the same training and a bunch of like things that like were very in common. It was very odd that it was like, sometimes things just happen and they work out for a reason. Well, it was kind of like that. But in terms of mitigating some of that, so, obviously cross-border buying, of businesses is also a whole other arena. And so we had to have a lot of consultation, mitigation of strategies via like different cross-border lawyers and accountants and debt and all the things, right? And so when we came over though, we bought just the businesses, not the real estate first, because we didn't have the amount of credit required in the US to purchase the whole thing. We bought the business based on the EBITDA or the NOI, which is the net operating income. So we were able to float that, but it wasn't looking like we could float the real estate as well when we purchased. So it took us 2 years. I started to get some credit history after about 24 months. And then we were able to then start the process of purchasing the real estate. And so what we did is we purchased the real estate just before we actually sold. It was maybe about a year that we had held the real estate, but we did a first right of refusal on all the real estate when we purchased the business to ensure that we could have that option, because that was our whole goal, was to buy it all.
Okay.
Yeah.
And so was real estate always something you were looking at? Because if I'm getting the story correct, it seems like when you sold the Montessori school, which was in 2021, that was your first time entering in the real estate industry, or was there history?
So in 2001, we sold the first group in Canada.
Okay,
and so when we sold the first group, just prior to that, I would say about 5 or 6 years into the first business, we started buying the real estate and holding it as a holding company and lease backing back to the schools. So the schools would pay us monthly for the triple net rent. And so we created a management company to basically hold the real estate and operate the real estate through. And so we paid ourselves as the manager of the real estate, as well as then the holding company owned the real estate, but the holding company was also us.
Right.
So it's a bit of a strategic and intentional structural setup.
Yeah, absolutely. Yeah. And that's something that you can get the entity structure right and down packed. You're finding a lot of savings just through that. And then
and then like in the States, there's a lot more ways to strategically or strategize around tax mitigation, where in Canada, we did not have nearly an iota of the amount of tax strategies we have here. And so just in the tax savings, we increased our income by about 30% right off the bat.
Wow.
So being able to strategize the corporations properly, and also the pass-through entities, and S Corp versus the C, and having so many LLCs and holding companies. So it was really a matter of, our accountant here was, I would say, super critical in all the decisions we made along the way. Like, he was pretty much our mentor, honestly, here in the States. And so I don't think people realize the importance of an incredible accountant and an incredible lawyer. Like, we had both. It's a team sport, right? Buying real estate and owning businesses, it's a team sport. We come together and strategize often together because we need each piece. Like, we need the accountant to talk to the tax strategy, to talk about the income and how to manage it. And we need the lawyer to make sure that we're doing everything according to what is acceptable and all the pieces. So he was an integral and critical part of our sale, and honestly of our build up.
Wow.
Yeah.
That's awesome. Yeah. And we see a lot of people that have accountants and lawyers are an important part, but they're not sure how they find the right one or what questions they should ask. It sounds like you kind of struck gold with yours. So for somebody listening, what are some of the things that you knew you were looking for? What were some of the questions that you approached him with, or how did you know it would be such a great fit?
So he was on a referral. Which was incredible. He was on a referral from our lawyer, actually. We struck gold with as well initially with whole relationship. But the accountant that we ended up, a CPA, he's this full CPA, and he's actually a tax strategist. And I would say that you really need to look for someone who has a really great amount of knowledge in tax strategy, in setting up your corporations and structures the right way to mitigate that. Also, not only just for now, like for your current, but you also need that for your legacy wealth. So we created a legacy trust. We created an IDGIT. We have all these things in place to mitigate generational wealth. And so many folks look at an accountant like, okay, they're my numbers guy. They're going to give me my monthly, numbers and my yearly, what I should kind of mitigate for tax, but they're really a partner in your long-term wealth. And so we don't do anything without talking to Vince. Like, we go to him all the time and we're like, hey, what do you think? Or this is what we got. Can you look at this investment for us? What are you thinking? Like, do you think this would be good for us? So we actually, he's a huge part. We consider him family, honestly. I mean, he's a huge part of everything we do. And with the sale, we couldn't have done what we did without him.
Yeah, no, that's great. I do love the idea of bringing your accountant into the family because, some of your most crucial decisions are going to be related to family. And one thing we do is we always make sure we have a clear grasp on what you want in the next 6 to 12 months, where you see your family going in the next 6 to 12 months, as well as long-term, whether you want to exit your business or your real estate. And it sounds like that's one thing that was very clear from the get-go in your relationship.
It was, and really important for us. Yeah. And so even when we went to talk to our legacy, wealth estate lawyer, Vince came to the meeting. We had him sitting in, he structured whatever, he told them what we currently had. He made sure that everything that was structured moving forward had the best interests, for our kids or our legacy in mind. So super important.
Well, there's so much to cover on the real estate side. I think you've mentioned triple net leasing. So for the person listening, maybe they're a beginning investor or maybe they're established, but triple net leasing is kind of one of those things you don't always hear about. So if you don't mind, just broad view of what it is.
We took a very unique approach to investing. So our website is thejulieroy.com, and I'm only going to plug it because there's a lot of information on there about how to invest and what we kind of coined as our trifecta strategy of investing. And so I'll tell you a little bit about it here just because I know we don't have a ton of time, but what we wanted to do when we exited was obviously keep the most money we could, right? The goal was to keep the most money we could without having to give away. We wanted to give away no money, but of course that was impossible, but the least amount of money. So we also needed a plan to work with the end in mind. And so we actually have a book that talks about that, but we needed to know what strategy we needed to put in place so that we could have something cash flow to replace the active income we were losing. Because when you sell a business, what you don't think about, you think about, I get this, let's call it $30 million for selling our business. Sure. Well, you think, we're good. No, you're not. Trust me, that money starts going quick. And so you just keep seeing debiting. We were like, we're not going to do that. We want to have a strategy in place so that we have a clear end in mind. What do we need every month? What do we need to be, what do we need to do to replace our active income to continue to live the lifestyle? We didn't want to change the lifestyle we were living. And so in order for us to do that, we started with triple net investing because it was a very clear and easy way to replace the active income. Yeah. One, it creates monthly cash flow. So we have invested in places like Starbucks, KinderCares, Taco Bell, CVS, all the things, right? So every month, those triple nets, they're called triple net because the landlord or we have zero responsibility, which we really appreciate. Yeah. So they pay the taxes, they pay the insurance. We're not affected by any of that. They pay you a clear amount of rent per month. So you know exactly every month. There's no guessing in triple net. You know exactly every month what rent is due to you. So we have 5 Starbucks, I think, or whatever. But so let's call it 1 Starbucks. They will sign a lease with you. The minimum amount of leases we have are 10 years or up. We only buy new builds. We only buy from the developers. So we have a great relationship with developers. So they come to us with a lot of products because we've been consistently closing. So it's really great because we have a lot of choice. So for example, we just bought a Starbucks down the road. Their rent is $13,000 and change a month. It doesn't change. Every month on the 1st, we get that rent. And then in our leases, we have something called a rent bump. So every 5 years, this lease particularly increases by 10% or 2% per year. So you're mitigating inflation, you're mitigating risk by this rent bump. You're also increasing the appreciation of your asset, right? So your NOI is going up. You're getting a nice, consistent 5.7% cash flow a month on your money. You also have the ability to make money on the sale end as well for the appreciation. And with the rent bumps going up, you're always going to have a higher NOI. So even if there's rate issues, you're mitigating that, right? Wow. So what we've done this year is we've only bought just cash, which that's a little bit different and we syndicate. But before that, we would buy obviously with debt if it made sense with the cap rate. But right now, the cap rates and the interest rate are upside down. And so you have to buy pure cash. So there's a whole strategy around the triple net. But why we did triple net was true passive income without any work replacing the active income we were losing from the business. So it was the perfect option for us to continue to live the life we wanted to live without mitigating lifestyle or mitigating, changing anything that we were already doing. The issue was then, Chris, we got a huge tax bill because we don't have the business stuff to write off all these things. So we were like, okay, second strategy, we're going to invest in multifamily to eradicate the tax. And so what we did was we had a $500,000 tax bill from the first mitigation of the net wealth we received from the triple net, right? So we invested then the money into multifamily to eradicate that bill. So now we own multifamily, which is awesome because it's another asset that's appreciating. We get a little bit of cash flow. It's not a cash flowing product, multifamily. It's too variable and there's more work involved. So we are GPs or general partners in syndications for multifamily, mainly for the tax basis or the tax write-off. And of course, as you know, the government gave 100% that first year. So that was really great for us. This year, it's 80%. The issue with this year is the loan to value structure. And the issue that most folks are having to raise more, borrow less. So as you borrow less, the tax depreciation is less. This gets a little bit boring and, but it is something you kind of need to know, right? So, and then the third part of our investment strategy is storage and industrial. And so we do that for a longer term IRR, which is internal rate of return. And so we're going to get different capital exits for us because we don't want capital gains all happening in 5 years or 3 years and we don't want all the same asset class. So this helps diversification of portfolio. It gives us cash flow. It gives us mitigation of tax. And then it also gives us sort of what we call a riskier environment, but it's not really risky. It's just different because storage is value add. So like this year we bought with two really well-known syndicators who are in huge amounts of spaces. Pace Morby. I don't know if you know their name. So we bought with Pace and Alex Kazeta, who's awesome in storage. And they flipped a YMCA. So we're flipping a YMCA. That part is already running. And then we bought all the land around it to add up to 80,000 square feet of storage. So there's all these little projects we're doing around, but basically that's the trifecta. And that's why we did what we did. It was really based on replacement of active income. And then we had a tax problem. So that pushed us into the multifamily. And then, like I said, storage industry. And we also are doing car washes. Car washes, that is real estate and business. And it's a fund. And that also offers 60 to 80% depreciation. So helps us when the multifamily stuff is a little lower.
Right. Absolutely. That's incredible. It's like, most people would. So one thing I saw on yours is that you are able to create passive income. And I think most people get into real estate because they've been told passive income. You just make money. You don't have to keep up with it. But then a lot of people get into it and are like, this is not passive at all. I'm working harder on my job. So with triple net leasing, it truly is passive income. Now,
even our syndicators, they're like, Julie, I can't believe this. Like we're getting money every month, like the same amount. Like they're not getting that in any other asset class. And so the issue is historically and typically we did a huge portfolio on our own, right? No syndication because we needed it. People kept saying to us, how can we get into your syndicate? Like, how can we do this with you? We love this idea, but it was literally impossible because the amount of money, right? Say like, this year, you would need $3 million to get into a Starbucks. Right. No, not very many folks have $3 million to just go and buy a Starbucks, right? Unless they've had a huge capital event. So we were able to then bring them into the syndication and they love it. And we do a 90-10 split. We're super fair because we're doing this because we know we are here to help folks now. Like we believe in generosity breeding abundance and it's just been the whole time. And people could not get into this asset class otherwise.
Right.
So it's kind of an interesting why we started was basically because they asked us to, like, we weren't even going to syndicate triple net. And they were like, please, like, we'll give you, we want to partner with you, but they didn't have $1 million or $2 million. They had maybe 100 or 200. Right. And they want the return of it being backed by the real estate. It's just hard. It's not an easy asset to get into unless rates are amazing or you have a lot of money. Right. And so this has been a good way to mitigate the blockages that were there prior to getting into this asset class, unless you're crowdfunding, which that's a whole other, and then you don't know the people. Like, I don't know. I really believe in having trusting relationships with my investors and them as like me too, like going into an investment. I want to know the jockey, not the horse, Right. So So that I think has helped a lot of folks get in. Like we've brought in maybe 100 people over the last couple of years with us. And so just really trying to give back at this point. Our split's 90-10. Like we're not doing 70-30 or 80-20. Like this stuff doesn't even happen in this area. No one's doing splits of 90-10, 90 for the investors, and we don't do any fees up front, no acquisition fee, no asset management fee. We only do a disposition at the end if we make you the money.
Wow.
So we're just very, very about integrity, right? And doing the right thing for people.
Absolutely. I've been listening to a lot of Zig Ziglar lately and he has something that says you can have anything you want in life if you help enough people get what they want. And I think We see it in your life. Yeah, that's incredible.
Yeah.
It's awesome.
Right. We call it karmic gratitude. It's just definitely like we have received so much generosity back.
Yeah. That's so. Now, I got two questions. One is, do you guys have a minimum investment that you look for from people that are getting into syndications, or?
So in triple net, normally it's about 120 because we try to break the triple net asset into shares so that we can guarantee what you're getting a month. So it's just very easy and clear. We don't do any prefs. There's no waterfalls. There's none of that crap. It's just literally, this is what you're going to get per share. And then obviously at the end, we share whatever is made in the appreciation based on the shares you own. It's super simple. So normally it's been 120, 125, just because it works out for shares that way. We do have sometimes folks want to buy a half share, and we will offer that if we have somebody else that will want the other half. Normally though, I would say 120 is kind of the minimum. For multifamily, we've had 50 and up, it just depends. But for triple net, it's been a little higher because we also don't want 100 people in the deal, right? We want to have an intimate investor load. And so it's usually 20 to 30 people, maybe, and some people buy 6 or 7 shares, right? Like sometimes people want a lot because it's a moneymaker, right? If they've sold a business, they want something to replace that. Like I talked to a doctor this morning and she had sold a practice and she's like, we have all this capital and I want it in something that's going to pay me monthly because I was used to getting rent, right? And so like that we're really in that space of folks that want to replace active income, to exit a W-2 or whatever have you. Yeah. But we don't want it to barrier to entry either. So we try to do 506B because some people just aren't accredited yet. Right. Yeah. And we will work with them if they have a minimum that we can maybe pair with somebody else. Like we did one time, we had someone come in with 30 and there was 3 of them siblings and they came in with 33 each.
Wow.
So we made it work because we just want to make sure like we are not putting barriers up to opportunity because that's not what we're about. So. Right. So, I mean, generalized, yes, that's the minimum. But we're pretty cool in terms of like trying to help you get in. If we can, we'll do what we can. Yeah.
Absolutely. That's so good. Now, because we could listen to your story, Julie, and you're very knowledgeable about real estate and like you've been through a lot and acquired a lot and done a lot, had a lot of success. But I can't get the thought of Julie back in 2001 who had a $25,000 investment at a 19% interest rate. So what are some of the things that you learned along the way that you don't forget and could be beneficial to the person that's just
so much. So in our house, we don't have failures. So I think that's really important. Mindset is key. Like I would say it's 98% of what you do in life. Prior to my $25,000 loan, I came from a mom who worked 3 jobs, single mom. So I was working like at 10, 11, started babysitting everybody on the block. Like I was always very entrepreneurial because I had to figure out if I wanted stuff. I had to figure out money, right? I worked on the weekend at a market, 5 a.m. I'd drive my little bike downtown, like far, to work all day. So work ethic, you can have all the ideas in the world and the best mindset, but if you can't put anything into action, that's never going to happen. Yep. Work ethic, you have to be your best pusher, your best, motivator. You have to wake up on the days where it's really shitty and be like, you know what? I got this. I'm going to figure out like every morning, I do a gratitude and journaling practice. I didn't start that, the Julie in 2001. Julie in 2000 was like, help, right? But I learned a lot. I call them lessons. We don't have failures. We have lessons in our house. And so it's a lesson because we didn't quit. If you quit, then it's a failure. So we put that even with our kids. We're always like, look, at the end of the day, what did you learn today? Right? Because what you learned is more important than what you did, or didn't do. But so I would say, some of the most important things are mindset, work ethic, find yourself a mentor. Like for God's sake, find yourself a mentor. They can help you compress timelines. They can help you avoid mistakes. I'm also a mentor to 12. I only allow 12 into our group. We do it's called Wealth Masters. You can find it in our coaching program as well. We bring 12 businesses in and help them scale either for exit or we help them create, higher levels of EBITDA for better multiples on exit, or we help them create legacy wealth. If we haven't got them before sale, we'll try to help them after sale because the first sale, we had no idea what to do. We had all this money and we were like, great, now what? Right. So we didn't really have the mentorship we required. So everything we didn't have or we thought we lacked, we created for people because we were like, it was just so hard to navigate. Who can you trust? Who do you want to put your money with? Financial advisors, I'm not into. Like a lot of financial advisors gave us information based on their commission, not what was best for us. And so why we always have Vince, our accountant and CPA involved, because that's a whole other, discussion. But I would say, have the right people around you. I was always the dumbest in the room. I always tried to put myself in rooms where people were so much more above me. Now I'm being coached by Grant Cardone. I'm a one-on-one client by him. I pay him a ton of money a year. I've spent $350,000 in the past 18 months on mentorship. So and I feel like I know a lot, but I feel like I have so much more to go. Right. And so I'm putting myself in rooms with billionaires now. Right. And what I learned from these is that you need to think big or think bigger. And I think a lot of times we don't think big enough. We limit ourselves by imposter syndrome or, strategizing around, well, we're okay. We're doing good. Satisfying. I was an entrepreneur that it's still never enough. I mean, I think it's a slight addiction. So I feel like there's a lot of things that you need to be successful along the way. Yeah.
I think mentorship has proved beneficial in just about everybody that will offer some sort of advice. And then, there's not failure. One of my friends, and he's a mentor too, is no failure, only feedback. And it sounds like that's kind of.
Yeah, pretty much. I mean, as long as you're learning from the lesson, then I think it's okay. Right. And I also think that beyond the mentorship piece, investing in yourself first. A lot of business owners make the mistake of investing only in the business. And at the beginning, that was a mistake I made. And I learned heavily by doing stuff twice or the wrong way, or, when I could have. I think at the time though, too, we're talking almost, 20 years ago, I don't think the availability of mentorship was as fluid as it is now. I remember trying to even look for piecemeal help, and it was really challenging. I feel like now many people are in the mode of, coaching, consulting, giving back. We didn't have this array, or maybe it was because we were in Canada. I don't know, but I didn't have the array of access and proximity to power that we do now. Yeah. I
think that's through the power of just social media, and people are sharing their stories more, which is great. But at the same time, beware, because there's some people that don't have their best interests in mind, and you got to keep on the lookout. But I do think that most people are. Another thing Zig Ziglar says, or maybe it was Zig Ziglar, but it's this idea you have to create value. And if you're not creating value, if you're just scamming someone, you're not going to last very long. And that's capitalism.
Exactly. And the other thing I was going to say about that, Chris, is two things. One, if you're looking for a mentor, because people ask me, well, how do I find a mentor? What's the best way to find a mentor? Look for someone that you want to be like. Look for someone who's doing what you want to do, right? So don't look to somebody who's the same as you, or maybe a little bit above you. Look who someone's 5 years out from you, or 10 years, or even maximum life out from you, right? So if you're looking for someone who's living off 100% passive income and who's doing all this stuff, look at somebody who's done it. Don't go for mentorships that are not proven, I guess. I feel like there's so many gurus out here talking the talk, but they haven't walked the walk, right? And it's different to talk about it. It's like going to I always compare it to college. You go, you take a business class. You take an entrepreneurship class from a professor who's never ran a business. Right. My son that happened to him this year. He's 19 and he was like, Mom, he called me. This guy has no idea what he's doing. And I said, okay, but he's a teacher. You can't go there. And he's like, well, he told us not to take debt. And he's like, he has no idea about leveraging debt. And I said, because he's never ran a business. Wow. He's a teacher, which is great. That's awesome if you're teaching theory, but in reality, theory doesn't work. I mean, it really doesn't, So yeah, it's the same thing in mentorship. Look for those who are where you would want to be. And also never accept criticism from anyone around you or noise around you from anyone who's doing less than you. Everyone doing less than you are those that will criticize you. Right. Have you ever seen anyone doing really great that criticizes anyone? They don't, because they don't care. They're too busy doing great, right? So Grant always tells me, Julie, you're going to hear a lot of noise. You're going to hear naysayers. You're going to hear people say, you can't do that. That's ridiculous. Look at her, who she's trying to be, blah, blah, blah. But those are all people doing nothing. He's like, look at me, who's like, Julie, go for it. That's awesome. You're not doing enough. You need bigger, right? So I think it's just putting yourself in rooms. Sometimes you have to change friends, family, all the things. You have a lot of people that are around you that, this is another thing I'm going to say. They're either building your empire or they're helping tear it down. So you have to make the decision in life who those people are going to be around you. Yeah. It's critical. Yeah. You're going to lose people and you're going to be sad about it. And I'm still sad about some people that I'm losing or have to lose, right? I know there's some weight bearing issues around us all the time, right? And so you have to say, okay, do they have the same mindset? Are they, thinking the same way? Are they going to push me to build this empire or are they holding me back? And that's a decision, unfortunately, weekly, monthly, yearly, you're going to have to face. Yeah.
Take inventory. You got to take inventory.
Take that inventory for sure. Yeah.
Awesome. Well, your focus on family is definitely inspiring because a lot of people will get to a point, they've achieved some sort of success, but it's at the cost of relationships that really matter. The ones, the most immediate family, your husband and your kids. Now, you're in business with your husband and your kids are now exploring entrepreneurship and clearly have a driven work ethic. For the person who's wondering how, because we also hear these horror stories of the richest people, the wealth is gone in 3 generations, right? So how do you instill that work ethic that has meant so much that you got from your mom and pass it on to your kids? And
and my mom and dad both independently were and my grandparents, I'm Italian, both sides. Immigrants work, right? We're just workhorses. They came from Italy through prisoners of war, my grandparents, to New York, to Michigan, to Canada. Like they did the grind, right? And so it's really hard to pass on that grind to kids living in today, right? Like 2023, never have had like a scarcity of food or protection or security, right? Like, so it's really hard. One, I would say first and foremost, I'm a mom, right? And so I had these businesses and was having children at the same time. So I feel like we also, as a female, as a mom, I had additional issues to deal with. Okay. Like mom guilt and all the things that like I was grinding and building my business in the time where all my children were very, very little. Like I had a baby on Friday night, went to the school Saturday morning, did payroll with him, and he came home after that. Wow. Like, so when people look at me and like, oh, she's so lucky, or, oh, she's so rich. Like that came with a lot of pain. Like I can sit here and tell you all the great things I know now, but it was not easy. It was 28 years of grind. I loved it. Right. And was so committed to my success that the dream was bigger than the nightmare. Right. But you have to go through all those pieces. And my kids were very much a part of the entrepreneurial journey. I had no choice. They were in the schools with me. They were in the business, whether they liked it or not. We would go open a school on the weekend or move a school. And those kids were opening boxes, putting shelves together I have pictures. They're just tiny little guys and girls. That's always a girl. We have 3 boys and a girl. And they were always in it, and they remember like all the things of the journey. Right. And I think it's really important as parents, if you're entrepreneurial, to have your children be part of that journey, to have them understand not all the good stuff, but also all the trials and tribulations. And as much as you can expose them to some pain. It's hard for me because I want to give them everything. I want to do everything for them because, I'm their mom and I want to give them everything we didn't have, right? Mm-hmm. My husband is really good at keeping me grounded. He's like, Julie, adversity breeds abundance. So he often puts us back in the track of like, hey, pain is okay. They can have some pain. It's okay. Like they don't have to have that. They can work for that. They can, And so my son my oldest, he's had a job since I can't remember. He started at McDonald's. Like he's always been working and going to school. My second one's in pre-med. So he's always played a varsity sport, which we considered like a job, and also studied. He's, he had 5 or 6 AP classes a year. Like these kids are not taking the easy road with anything. Right. And I think if anything, if you can teach them that the hard road leads, to a good ending most often, or as much as you can, they have to have some of that pain though. I fear like this society in general is giving the kids everything. And then the appreciation of where that came from is really hard for them to understand. Yeah. So we try to keep them grounded. I mean, look, they have had experiences no other kids have had, right? Yeah. I mean, they have been all over the world. We've talked about that. We can talk about that in a little bit, but they have had experiences that absolutely a lot of other children have not. Yeah. However, my children are so humble. Mm-hmm. Like they don't talk about, where they don't dress in labels. We've kept them as grounded as possible. Like they have no idea, I don't think, what we really have. Oh. Like they know we're good, but like they always ask us, well, like, what is our net wealth? And what is, I'm like, you won't know till you can get there. Right. Or whatever. Right. So when you can get to the same net wealth, we'll have the conversation, but they don't really know, obviously they know we've done well and they know we've sold, but they don't really know the minutia. Mm-hmm. And I think that's important too, in some sense, to keep them grounded. They need to not be aware of all of that. They need to be aware enough, and so in terms of keeping the legacy wealth, a big piece for us has been teach your children the financial literacy, teach them how to make their own money and keep their own money, right? We talk about spend, save, and invest. We talk about what an income looks like. We talk about, we're taking them to a financial literacy course next week for 2 days in California. We're putting a lot of time into them. We take them to all of the events, Cardone events. We spend the money, we invest in them in their person, right? Because they need to know this stuff. And guess what? If you have a legacy and they don't know what to do with it, it will last 1 generation. Right. You want generational change. Yeah. They need to have the education and they need to know how to keep that, right? And that's really important for us. I didn't work for all this for one generation, you know. We want to change the trajectory of our family forever.
Yeah. That's so good. And I see it taking place in just the way that the few stories I've heard, it is making a difference, which is a good way to transition towards the close. We do have one final question that I like to wrap up. But before we get there, Julie, what are some of the things that you guys are aiming towards? I know we talked about your bucket list item that we're checking off here in a little bit. If you don't mind just going through that with the listener, because it is.
Yeah. So a couple things. So our bucket list is continually evolving. I have vision boards everywhere. Ideas all over the place. But one of our big goals, so I don't know if you can see this. I share this with everyone on the podcast, but at the door, do you see that black plaque?
Yes, I do.
That's our family mission, vision, and values, and our core values. And so every time that our family walks through those doors, it is a reflection of what we want in this house, how our behavior should be, and also what we're predicting for our future. So on there is travel and my love of travel that I never had when I was a kid. So I wanted to make sure that the kids all had that. So we are finishing our 7th and final continent, December 28th. I turned 50 on December 29th, and I said I wanted to do continents with the kids before I got to 50. I'm going to be emotional. Okay, this is so crazy. And I'm so scared as well because it's like my scariest adventure because it's an expedition and I don't like boats and crossing the Drake and living on the other side of fear, right? We talk about this all the time, but it's real. Like this is real. And so we will be finished that December 28th. I actually get home on the 29th, which is my birthday. And so that's super cool. And so, a big goal, a big check box. But, and funny, like yesterday, I'll probably get emotional again, but yesterday I got a text from my oldest son who's at college and he was home for a weekend just doing something with his Jeep and went back to school and he texted me and he said, I just really want to thank you for all the opportunities that you give us. And I was like, oh my God, like as a parents, right? Like this is where you get to the apex of parenthood when, your kids can appreciate what's going on. And he said, this like experience to travel to all 7 continents, like how many kids can say, that they were able to do that. So just really creating the right mission, vision, values, creating those core values in your family that you can all commit to and adhere to, and also really just commit to your success as a unit, right? As a family, like we're all working towards the same goals. And I think that's really important for anyone, whether it's a business, professionally, personally, or financially. Commit to your health, commit to just commit to the success. And the success means all of that, right? It can't just be a financial return on, we don't even say return on investment anymore. We call it our return on life. So we evaluate the personal, professional, and financial health goals. Like everything has to be evaluated for us to create that return on life.
I love that. Return on life. You don't have that trademark, do you? I'm going to start saying that.
I hashtag ROL, and I've been saying it for years. And it's just like, this return on life, like it's such a different concept, right? I mean, it's a concept of not everyone, we talk about return, you're a money's guy, right? We always talk about return on investment, but return on investment means so many more things, right? Freedom of time is a huge return on investment. And so like, your health, if you don't have health, you can't have wealth, you can't have anything, right? So like, it's important that every day I'm doing, I'm committing to getting down to that treadmill and doing my 3 miles and, keeping myself healthy for my family so we can create these goals. So I'm 50. I'll be 50. Everyone's like, they don't even believe that I'm 50. We're doing a trek to, on National Geographic to like the Antarctic. Like if you want to do these things in life, you have to commit to success in all ways. Like it's not just the one, like you can have finances. If you have nothing else, what matters? Who cares? Right?
Yeah.
So it's important, even though this is about numbers, to talk about it as a return on life.
Absolutely. No, that's so good. And before we get to the final question, is there's somebody listening that wants to get in touch with you, whether it's coaching or they want to be involved in your investments, what's the best way to contact you, reach out, see what you're up to?
So I'm on all socials, obviously. Facebook, Insta. Insta is at the Julie Roy. LinkedIn is Julie Roy. Facebook, I have Julie Roy and the Julie Roy. I mean, if you look up Julie Roy and you gotta see a picture of me. It's probably me. But our website is actually www.thejulieroy.com. So you can find all of our information on there as well. There's links to social. So you can follow us. You can follow our journey to Antarctica because we're going to be posting about that starting next week. So yeah, I'd love to, get to know all your listeners, help them if we can. I mean, my big goal on being on these podcasts is sharing our story for not only inspiration, but if we can help anybody by anything we've said, if it can change their life by even 1%.
Yeah.
We're 1% better tomorrow than we are today. That's what matters. Like we just got to keep going, right?
Yep. And I can speak from my experience that I did get at least 1% out of this conversation. This was a powerful interview and I'm excited to share it. So with that, Julie, we can give our last question of the day, which you have no idea it's coming, but we ask every guest here at the Know Your Numbers REI podcast one question, and that is, Julie Roy, what is one truth about money that most people regard as myth?
I would say that they think that it is maybe the be all and end all to to your return on investment.
Yeah.
I think I talked a little bit about obviously that we don't believe, that we believe that, but we don't believe that because money does in turn run all the things, right? In order to make you have the ability, let's call it, to do the things in life you want, to free yourself with the time to go work out, do a 3-mile run in the morning, to not be constrained by the handcuffs of a W-2 job or, all the things that when people aspire in life, I believe freedom is a really big indicator of when they've reached a utopia in their life, right? So I feel like money helps buy that freedom. And I think the myth is that money is evil or, money is the bad guy. Yeah. It can be used for really great things. And if you have a lot of money, you also can impact a lot more people. And we have a program, anything you do with us, 5% of our proceeds go back to something called lemonadeday.org. And it's an entrepreneurial organization for at-risk youth, like I was. So, wow. Trying to give back. So having money, people think that it's evil or that, it doesn't rule the world. But at the end of the day, when you have the ability to make that kind of money, you have the ability to make impact and change.
I love it. Yeah, I think we've had a couple episodes on that and like the spirit of money, and people don't really know that it's not money that's evil, but it's the love of money is the root of all kinds of evil. So I think that's one thing that's been corrupted in our world, and we do see it. And I think a lot of people are loving money in their poverty or in their W-2 handcuffs, and they're afraid to leave because they're afraid of that active income. And I'm so glad to hear that come from you. Yeah, no, this was great. Thank you again for being on here. Listeners, if you got any sort of value, give us a rating and review, let us know, and also connect with Julie. I'm excited to follow along and see this trip to Antarctica and celebrate her 50th birthday.
Make it.
Right. I'm sure you will. But no, thank you, Julie, for coming on here. This was great. And I do know that the listeners will get a lot of value out of it.
Thank you so much for having me. I appreciate you.